Good morning, good afternoon, and good evening, depending where you are on the planet. And welcome to the Tuesday, the 17th of May, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. Go through our usual, normal, regular run through in here today. Calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires. What are the macroeconomic, geopolitical, fundamental events that are impacting markets right here, right now? And we'll also take a look at the charts and see where the technicals are, see where there may be some opportunities for today. Let's take a look, first of all, at what we've had and what we've got coming up. But first of all, what we've got coming up, actually what we've had, UK employment reporting here this morning. You can see sea of green, so all positive across the board there, and also GDP data in here beating expectations. So across the board, just showing that the European UK economies are still strong. Obviously this is kind of backward looking data, but the inflationary pressures are not, and the rate hikes that have come through in the UK are not yet having a significant effect on the labour market. So kind of a positive in there to be taken from that. Today we do get NPC member Cunliffe speaks, and that could be interesting given some comments that we saw. Yes, actually, I think he's already spoken. I think he's already spoken. We get Bullard today, though. And then later on today, we get Powell speaking, and also Mester speaking, but Powell probably the highlight. We did note yesterday it's not necessarily a big speaking engagement, but nevertheless, he may touch on everything that's going on right now in the world and the US economy. Harker speakers, we've got Bullard, Harker, and Mester all today. Lagarde from the ECB also speaks, and Powell at 2 o'clock, probably the standout, obviously, of those. Before that, we do get US retail sales data that comes in just under 1 hour at 8:30 Eastern time, 7:30 Central. So we'll certainly be keeping an eye on that. The retail sales data consensus forecast in here, according to investing.com, 0.9% for the month-on-month data. On the main retail sales number, the core retail sales at 0.4. So we'll certainly be watching for all of those things, particularly the FOMC members speaking, and of special note Powell to see if it adds anything. But he's spoken quite a lot recently. He's kind of made his case quite clear, so probably not going to get too much more potentially from Powell. Just winding back to yesterday, I just want to focus on this. So this was Governor Bailey, Andrew Bailey of the Bank of England. He was in it's front of the select committee in the UK, and was being asked questions, and he he apologized for a apocalyptic view of the world. Monetary policy faces its biggest test in 25 years, with surging inflation exacerbated the war in Ukraine and China's COVID lockdowns. He highlighted the fact that there could be a still more aggressive wave of inflationary pressures coming through because of all these factors, and particularly coming through from energy and food. Not a great outlook, but we'll be watching these. They're not highlighting here as well. Jerome Powell and Lagarde speaking later today. Not a great view being put forward in here by Andrew Bailey, warning of potential ongoing inflationary pressures. So that's kind of from yesterday. Looking to 5 things to start your day from Bloomberg. Global customers are overpricing the risk of recession. I've got an article on this. So global equity markets are overpricing the risk of recession compared to other corners such as government bonds, investment grade and high yield debt markets, according to JP Morgan. So they're not saying that it's completely overpriced, the risk of recession, but it's saying it's overpriced compared to bond markets and debt markets. Okay, the probability of recession over the next 6 to 12 months remains low. This is from a JP Morgan strategist, and there's a further article on that here from Bank of America. Sorry, that's the wrong one. Where are we in here? No. There I do an article on it somewhere in here. We'll come to it as I go through the tabs anyway, guys. So they're pointing to the fact that maybe we're the market's over-egging the risk of inflation. More shenanigans between Elon Musk and Twitter. He won't proceed with his 44 billion takeover. That's a social media giant can prove bots make up fewer than 5% of its users. Bitcoin edged back above, it's up backwards and forwards through $30,000. All this fallout from the Terra USD stable coin is still causing problems in that market. Stocks are up this morning. A really strong rally in here in Asian markets, following through into European markets, pulling US futures higher. It was a fairly quiet day yesterday, you have to say, right? The market was kind of sideways yesterday, but it did consolidate the strong gains that we saw from the intraday rebound we saw last Thursday and the strong rally we saw on Friday. So yeah, I mean, it was a pretty solid performance yesterday, even though markets didn't really go anywhere. European markets were slightly higher, US markets kind of marked time, slightly dipped back lower, but it wasn't a big dip lower. I didn't really give up much of the ground that was gained Thursday from the Thursday intraday rebound through Friday, and then a really strong overnight session in here through the Asian and early European sessions. And then in here, they're highlighting all the data and events that we've got coming up through the day, which we've already gone through. And a similar story in the, so that's the that story there. So yeah, so US futures catch risk on wave, dollar retreats. That's important as well. We've been talking about this a lot. We've been talking about the fact that all the other markets have kind of started to turn at the end of last week. We saw European equity markets rebound. We saw US equity markets rebound Thursday through Friday. We saw more of a positivity to the bond market through last week. But the one market that hadn't moved in here, so we've noted it since Friday. Bond markets have been rallying. Bond markets have been going to higher prices, lower yields, and stabilized. Remember, the US 10-year yield had moved back here up through 3% level, and now is back below 3% level in here. And then we also noted that from last week, and we'll come back to the charts, but if that intraday rebound Thursday, strong Friday, solid on Thursday, and look, a really strong recovery effort in here this is the S&P, and if we go to the Nasdaq in here, similar in here for the Nasdaq in here, and it's poised at these peaks in here as well. So the Nasdaq about to make a more bullish statement, and the S&P 500 similarly at this impulse peak up here, taking out these two peaks in here. That's important for the S&P this morning. So, but if we go to if I switch tabs in here and we go to the dollar, we've been noting the fact that the dollar stayed strong throughout, really impulsively strong. It did have a little waver on Friday and slightly yesterday, but look at today, boom, that's a topping pattern, right? It's taken out these two, all the gains from last week, this last impulsive move up, having consolidated in this kind of area for some time, and with this last impulsive wave higher through the middle of last week. And look, we're down right near this low. So on the dollar index, that low is at, where are we? This low here from I think it's from last Wednesday. So it's just come back. Tuesday, Monday, Friday, Thursday. Yeah, last Wednesday's low on the dollar index is at 103.45, 103.40 and a half. That is 103.40 and a half, and the low today 103.42 and a half. Okay, so we're sitting right on that low. I think it takes out this low in here. That's a more significant topping pattern for the dollar index. And then if the dollar starts to retreat lower, that can allow US equity markets, obviously a strong dollar is negative for the US equity markets. So it can allow the US equity markets to maybe catch up on their European counterparts. And it can mean it takes some of the pressures off of the global currencies that, the strength of the dollar is not good for emerging markets particularly, but for other currencies as well. With respect to importing inflation. So we spoke about that yesterday. So a lower dollar will be good at the moment, and we're certainly seeing that it's the biggest down move. We'll see this big down move back here, back at the beginning of the month, but that was completely reversed. So if we can stay lower in here on the dollar, if it goes and attacks this low, if you're trading this is not for today, but on a bigger picture, if we take out this low in here from the beginning of May, the 5th of May, then this looks a lot more negative, okay, for the dollar. So yeah, a real potential for a bearish reversal of the dollar. So really watching out for that, and that could help the whole risk on move. And this is obviously the dollar's bid because it's the ultimate safe haven currency when we're in a really dire straits. And also it's been helped by the fact that the Fed are so hawkish, right? But remember, the US Treasury bonds have turned more recently, but the dollar didn't. So this is an interesting development. I think it should be noted. Take out that low. That's going to be important. That could trigger some more selling of the dollars if we take out that low today. Also keep an eye on EUR USD, euro versus the dollar as well, for the upside. Taking out the resistance points. Check out my daily reports for the important resistance points on the euro dollar. Because if that can start moving higher in here, that's going to help dollar index down, give you broader dollar weakness. Again, that can help general the risk on sentiment. So watching out for that. So I got a little bit sidetracked onto the charts, but you wanted to refocus on that. So yeah, Asian stocks in here. US futures catch a bid, Asian stocks high, China tech rally, and Euro area GDP surprises. Okay, so we've already covered that as well. Treasuries decline, European bonds fall, but oil still going higher, so that's kind of a bit of a negative. Futures climbs as technology and growth stocks rebounding. Yes, they're being driven by the tech sector more than anywhere else. So led by the rebound in pre-market trading, Microsoft, Apple, Nvidia, Tesla. So all of that are positive. Shares recover even as growth inflation fears linger. Okay, and what else do I have here? Stock market. Oh, here we go. This is the article I was looking for. Stock markets are overpricing recession risk. This is from JP Morgan. Okay, bullish strategies buy the dip calls haven't worked in 2022 so far. Okay, stock market pricing is higher recession risk than the debt and rates market. So he's not necessarily saying that it's pricing in more of a recession risk than the debt markets are, the credit markets are, and the rates markets are. But nevertheless, so that's somewhat of a positive. And then this was, I thought, was really interesting as well. You know, can be like seen as a fear gauge. Bank of America clients hoard cash at highest levels in 2 decades. The month of Bank of America survey. So this is a long-term survey. It's the Merrill Lynch fund manager survey. Now the Bank of America fund manager survey. It's been going for decades. Shows highest cash levels since 9/11. Hawkish central banks are now seen as the biggest tail risk. So the clients, the fund community in here is long of cash, right? They're out of the market. That means there's lots of cash to be put back to work if these markets start to recover. Okay, it means that we're kind of at a very high point of bearishness for the markets. Okay, so that again kind of echoes what we were talking about yesterday. Remember, the Dow Jones has posted 7 straight down weeks. The biggest succession of down weeks since 2001. No doubt, it's probably since 9/11, potentially since 9/11. Certainly since the dot-com bubble, right? So whatever that is, yeah, that's a sign that the market, okay, it's not moved to the extent that maybe it's moved in the past during the global financial crisis or during the COVID breakdown. So the moves have not been as big in a percentage or in absolute terms. Nevertheless, the fact that we've had 7 straight down weeks means that the market's probably stretched. It needs a relief rally. We've already seen that since last Friday, and you know, already seen signs of, you know, yesterday was just a consolidation day, but already signs today. I think we're going to get an up week this week. Is my strong, you know, I'm be playing this all from the long side at the moment, going into the day on the equity indices and certainly on a risk on outlook. But this bolsters that view that the long-term money is sat in cash now. So there's money to come back to work. A quick look at the indices. So we, you know, kind of marked time yesterday. We're not only showing the Dow and here, but look at the percentages up already this morning. So Nasdaq's up a couple of percent, and the Dow and the S&P between 1.25% and 1.5% up this morning. So really strong rallies being driven by initially Asia, China, and then Europe. And Europe up between 1% and 2%, depending where you're looking here. 1.5%, 2% here across the major bourses. Most of them up over 1.5% in here this morning. And just a quick nod to the Fed tool, very little change. We're seeing this for June and July, still sitting at 85% for a 50 basis point, 250 basis point hikes, and only 15% for a 75. And similar here. Actually, we're seeing this nudge a little bit higher now towards an extra 75 basis point hike in here. So we're currently at 75 to 100. So for the July meeting, we're now pricing in only like less than 80% chance of 250s, and now a bigger chance that between the two meetings we're going to get a 75, and even an outside chance now being priced in of more aggressive rate hikes. So this is actually pricing in 275s over here, right? But a very small risk of that, but more likely that we're going to, you know, a shift then definitely here at July of a more hawkish tone from the central banks, according to the euro-dollar curve. All right, let's take a look at the charts. I'll stay with the dollar while we're here. So we've already outlined the level there. Actually, look, we're breaking down through that level already. So we've already triggered through that level, another small level in here. And then, you know, I'm not saying it's going to go down here today, but the dollar looks very weak. This is going to only help our risk on view. And then if we go and take a look at gold obviously rebounding on the back of that. So we had a strong intraday rebound yesterday with that dollar weakness, a really strong hammer pattern. Now, whilst below this high here, I was remaining negative. But now we're above that high there, you know, from what's that, Friday, then this looks a lot more positive now for gold. So certainly now playing gold from the long side. You know, it's taken out this low here, this high here. You've got a bottoming pattern here, certainly not really an inverse head and shoulders. It's reversed these trend lines. We were looking at this yesterday. So a more positive outlook for gold. And certainly now having taken out these peaks here this morning, this looks a lot more positive. Impulsively moving higher, that's with that breakdown by the dollar in here. That's helping gold higher. Either you're jumping on this right here, right now, or you're waiting for the next little swing back lower on gold. Let's take a look at oil and finish off the commodities while we're here. Oil pushing yet higher. We took out that peak yesterday. Now you're looking at these peaks over here, these impulse peaks in here, and the actual highs that we posted back here in March. So, I don't see any reason not to be long of oil in here at the moment. Again, stepping into the 15-minute chart. We've just broken above, this consolidation phase. High here on the 15-minute chart, high here, looked like it was fading again, and then boom, up through that. It's been fairly gradual in here over the last hour. I would probably just go with the long in here. Definitely if it breaks the next high up here, which was at 115.43, going for the next long on gold. Let's take a look at those equity indices. No surprises. Risk on environment looking to be long in here. A strong push highs taking out these peaks in here. This is the S&P 500. Let's take a look at the 15-minute chart. Actually, I'm just going to step back from the 15 to 30 so we can see the resistances. So importantly, took out these highs here. So we yesterday we consolidated below these highs. We highlighted these highs in here. The high there, 40.50 and a half and 40.65 and a half. I've got these marked on my daily reports in here. We've taken out those already this morning. Another little high there as well, 40.69, excuse me, 40.69. Yep, taking out that high there as well. And then look, a little waver. I think this little waver here is your buy opportunity. Any kind of further dip, you see this little 13-period exponential moving average in here on the 30-minute chart. Any dip towards like 40, 58, 57 kind of area would definitely be a buy zone in here for me today. And then if it breaks above the highs, remember, look, if we go back to the daily chart, yes, we're up today, right? We've had a strong move, but we could easily be in for one of these kind of days in here today, right? So we could easily head in another 1% to 1.5% to the upside on the S&P. So up above 4,100, certainly possible. Going into today. Let's take a look at the NASDAQ, similar, but not quite as bullish in here on the NASDAQ on the follow through. You look at that S&P follow through in here today on the daily, up through the peaks in here, up through these peaks over here from last week. Okay. If we go and look at the NASDAQ in here, not quite so bullish. Is yet to make the statement, really, the NASDAQ. So there's more. This is where the potential really is for me, through these peaks over here. Okay. So if we zoom in here, again, I'm going to zoom it back from the 15 to the 30-minute chart. So these peaks here, look, these are the important ones, and we're just faltering here. So you've got three peaks. You've got 12,555 basically, 12,547, and 12,553, and then this morning's high 12,544. So through effectively that that peak there, but I mean you argue this one's the more important one, it's the more recent one. So you got 12,553 and 12,555, right? 75. So through 12,556, it's going to be an important move. So probably now waiting for that. But if we can break or a dip back again, this 13-period exponential moving average, that's down at around 12,450. A dip towards 12,450, probably looking to look for the next swing up higher. Waiting for this to play out because we are getting a dip in here at the moment. Maybe waiting through the retail sales data, maybe waiting for the cash market open in here for the opportunity. But certainly want to be playing this for the long term. It's going to have to really drop significantly for this to shift more bearish for me. So yeah, and then if it takes out these peaks in here, 12,556, then this can easily add another 1.5–2% to the upside today. So there is real potential in here for a strong day. We've already seen this, obviously, a strong day. NASDAQ's not quite. I think this is a really good opportunity on the NASDAQ in that we're not quite made the statement. You've made the statement on the S&P. You haven't quite made the statement yet. You've made the statement here today. You haven't quite made the statement on the NASDAQ. And I think that's where the real opportunity lies. That next wave higher, should we get it today. And this could easily, look, this is a relatively small bar so far. This could easily double the length of that bar up to you could easily be 12,950 today. Kind of that kind of area above 12,900. So yeah, I'll be looking to catch the next wave higher on the NASDAQ going today. That is just my point of view, though. Okay, guys, and obviously if we start breaking down through support, then the view changes, right? You're flexible with day trading. Okay, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. I'm going to say stay safe and take care, and I'll be back with you with another bull versus bear webinar tomorrow.